Let's dive in now to Enron, and I'll show you exactly how you could have spot the upcoming collapse in 2000. The thing to note is the margin compression here. They moved revenue from 13 billion to 100 billion, but they were only able to keep another 4 cents of profit per share. That's kind of a red flag, but I'll show you where the tricky part is in cash flow. This is what we want to do. In this case, 864, that's cash going out for reinvestment in their primary assets. The operating cash flow up above those three lines minus this capex is a positive number, which is very good, positive 400 million or so, which is excellent. They can afford their capex. They then pay a dividend of 208 or $281 million, again with 400 million of cash. After capex, they can afford the dividend, and they're left with a positive $120 million from their primary operations, excluding debt financing, excluding the sale of assets, excluding working capital, some of the other non-primary business related activities. Okay, now let's fast forward to 2000 and see what happened. Same line items, $2,979 million of net income, plus 855 million plus 207 gives me a positive number for operating cash flow, good. But after capex of 2.381 billion, it's negative. You then add a dividend payment on top of that of 523, and they're losing $863 million in cash that year. They don't have much cash in the bank. In fact, if you looked at the balance sheet, you would see debt would balloon to over $38 billion over those 5 years, from what started at 10 billion ballooned to almost 40 billion as investors piled into the stock. They issued a tremendous amount of debt. They took in customer deposits. They issued preferred stock, all because revenue was growing and people thought the train was going to continue to run. The stock was going to run, and investors were willing to give them cash, despite the fact that they were burning cash flow and nobody took the time to look.